also cafes and restaurants.
Let's rejoin Chris Weston from IG in Melbourne. Chris, warm welcome to you. Finally, some relief for those tortured by that elevated Australian dollar. Now let's project forward to year end and the expectation on where we might sit, and is that going to be a catalyst of another cut, maybe in November? Below parity by Christmas?
I think technically speaking, Carson, I think the big level we need to look out now is 101.67, which was the September low. I mean, if we get a break below that, then technically speaking, then we could potentially, the target for that would be 97 cents, which would be the double bottom neck target. So, I mean, that's what we'd say. But I mean, from a fundamental perspective, I do know that there's a lot of people looking to buy at that 101.67 level, which, considering as we're trading, we're just testing out of the overnight lows at 102.52 at the moment, looks like it's very, very achievable. What I will say right now is that probably from a sort of trading perspective, that we're looking to sell any kind of bounces. That we had a sizable move in the Aussie dollar yesterday, and I know a lot of people are short at the moment. There's going to be a time when people are going to look to take profits. If we see a move up to about 103 in the short term, then I'll be looking to sell into that level at the moment. Now, if you look at what's being priced in, I mean, the market's now pricing in an 80% probability that there's going to be another November cut. A lot of the banks are suggesting that we're going to see another 50 basis points cuts in 2013. Although if you actually look further down the curve, the actual trough of the rate that the money markets are pricing in now further down the line is that the rate could get as low as 2.25%. So clearly, from a rate differential, then the Aussie could feasibly trade below parity in the sort of next 6 months or so. What I will say, though, I don't personally think we're going to get down below parity by the end of this year. I think still, if you're looking at the Aussie dollar versus the US dollar, the Fed's moves are still very, very interesting. I think in December we're probably going to get in the early December FOMC meeting, we're likely to see the Fed announce that the Operation Twist program is over, and they're going to look to, instead of what they're doing now is obviously selling out of short-dated treasuries and buying longer-dated treasuries, is they're actually going to expand their asset purchase or their mortgage-backed security program by 45 billion and include US treasuries as well. So that will hamper any big downside in the US dollar, in the Aussie dollar pair there. So I don't think we're going to get below parity. That's my call anyway. And I think we will see one more rate cut at the moment, but I think that's probably priced into the curve. But I think we can go lower. I mean, it's still got to catch up with terms of trade. It's still got to catch up with the perceived fair value that a lot of the analysts have got at the moment. So, yeah, I'll be looking personally to see a move down to 101.67 in the short term, but I'll potentially be looking to buy there.
Chris, what about in the statement yesterday, the Reserve Bank's comments around China talking about the near-term prospects greater than it was some months ago, the uncertainty around the near-term prospects greater than a few months ago. Do you think that kind of gives traders fright? Just noticing we've also had a services sector PMI come out from China a few seconds ago. It just seems that's, as much as central bank expectations are front and centre, this China data still really gets people edgy, doesn't it?
It does indeed, yeah. I mean, there was three things that we took away, really. I mean, the market's taken away from the statement. One is obviously the persistent high Australian dollar, and I think if we do see the Aussie push back above 103, then I think that the market will really try and price in a really strong chance that we're going to get a November cut, so even more than the 80% that's priced in at the moment. They did flag the Chinese growth side of things. That was the second point that most people took out, and the second thing was the fact that the peak in the investment boom or the resource boom is actually taking place next year as opposed to what they thought. So then you can look at some of the other situations. They've downgraded their assumptions of the labour market as well. So yeah, I think clearly the market is now pricing in another rate cut by year end on the back of that statement last night. I mean, it wasn't there were some things that they did point out. They pointed out that the markets have rallied, the commodity prices have seen gains in recent times as well. So it's not an unadulteratedly dovish statement, but I think clearly we are going to keep an eye on China. If we do see a marked deterioration, then perhaps we could even get 2 more rate cuts this year. Who knows? But I don't think that's going to be the case. I think if you look at the HSBC numbers, the PMI numbers we saw recently, and also the headline, the official ones the other day, there are some signs of stabilisation in some of the Chinese growth metrics. We know that the handover is going to take place a month later than what a lot of people were positioned for in November as opposed to October now. So I think people have been buying in the hope for stimulus after the handover, but now they've got to hang on. Do we hang on given the fact that the handover and potential stimulus is going to come just after the US election now? It's a bit more of a worry.
What about this thematic inside the market of bank margins compression there, alongside that pressure for all of them to follow the leader, as it were, from what the RBA did yesterday? Are you changing your view on perhaps who's going to come out the strongest from all of that?
Well, I'm quite interested to see the price action we're seeing in some of the REITs and probably more so the home builders today. I mean, CSR had a good game yesterday. It's up another 3% yesterday. I think the market's pricing in about 130,000 home starts next year in Australia. And I think CSR, if you look at the valuation, has probably the most to gain in terms of re-ratings to the valuation from an increase to those home starts. Now, if you think that the cash rate's going to get to 2.5% next year, perhaps even 2.25%, what you've got to look for is that equation, that buy to rental equation, and clearly that comes in a dramatic fashion into the buy side of things. Does that increase the perception of housing starts next year? Perhaps, and that's why I think we're starting to see some money really flowing into that space, and I think that's when that it's definitely worth a looking, because they've had some good buying from the lows. James Hardy obviously having some big exposure to housing in the US, which is seeing really clear signs of improvement.
That's bizarre, because we've got an interview with HIA coming up. The Housing Industry Association, they say following 2 consecutive years of decline in new housing starts over 2010-11 and 2011-12, leading indicators point to weakness extending into 2012-13.
Yeah, well, I'm not going to claim to be a housing expert, but I mean, the banks at the moment are saying that they see, the investment banks that I've been talking to are saying that they see 130 to 140,000 housing starts coming through in Australia this year. So I mean, I'll take that. I mean,
well, that's really bizarre. A second monthly decline in August for new home sales. They can talk it up all they like. The numbers don't lie, do they?
Well, yeah, I mean, then you can look at other stuff, other bits and pieces. House prices seem to be improving, and mortgage arrears. We saw Moody's coming out today saying mortgage arrears are improving in July. I suppose you've got to look at it from a perspective that was old data. What happens in the future? We're always, as you know, as traders, we're always looking about what's going to happen in the future. Now,
yeah, well, Moody's just played catch up. You're just citing a Moody's number, which is historic data. You know, they're always late to the party, not ahead of it.
Okay. Well, let's have a look at another situation now. What happens if we do start seeing, I mean, because if the people who are actually going to be buying the mortgages or taking out the mortgage, should we say, are going to be reacting to these rate cuts now as opposed to what we saw in July. So do we now start seeing this flood of people coming in and actually buying more houses because of their perception that rate cuts are coming in and they're going to be able to finance housing at a much cheaper level? I think that's going to be the indicator we need to see, and that the market will try and price that in before we start seeing the anecdotal evidence coming through.
Well, we've seen a lot of stimulus that now arguably has had 12 months to find its way into the economy, and housing credit growth in August at its lowest level since 1977.
Fine, exactly right. No, so, but at the same time, mortgage prices.
So you would still say go into REITs, regardless of not having a clear picture on the overall level of demand. You would still say buy REITs.
I wouldn't buy REITs.
Well, the people are buying them as we speak.
Well, I think, yeah, that's probably the case. I mean, there are people buying into it. I mean, how long can that actually last, though? I mean, how long can the trend last? I mean, CSR and I mean, I'm not looking at the building companies as opposed to the actual the REITs, the investment trust. Okay. There, I think that's probably more the space I'd be looking at right now, in the perception that we can have. You know, increased housing demand going forward. I think if you go back to your point on the banks at the moment, I think what we talked about yesterday is on a price to book level, they are trading at the highest levels on their sort of multi-year range. The range of the banks have been talking 1 to 1.4 to 1.8 times. You know, a lot of the banks at the moment are trading at that top end. I think that's why a lot of the investment banks right now would be saying, you know, they're probably looking a little bit toppy. How much of the, I mean, we know that the story has been about, it's been about yield. Yeah. That's why people have been buying banks. It's completely been about the yield that you can get in there. They've been almost trading as a quasi-bond in that regard. How much longer can that go on? We'd have to see what's going to happen.
Do you have a guess on that? Because we've been noticing this past couple of days, you can still get people on saying, yeah, buy banks because of the yield. As expensive, again, I think the extension of that is, obviously you need a rally in bank stocks to get a rally in the overall market, maybe in the next couple of months. Can you see them continuing going higher? And you know, as much as we talk about rate cuts helping the share market, will they?
Well, I think the first point that you've got to look at is how aggressive these banks are now being in terms of deposits. I think that in terms of what they're not being as aggressive as they have been in trying to attract deposit flows. I think the offshore funding markets are becoming a lot more compelling to these guys right now. So if if they don't pass on the full 25 basis points, we get another one in November, and they don't pass on the full, then given that they're being less aggressive with term deposits, their net interest margins will improve, and I think that potentially puts some upside bias to valuations at the moment in terms of, and we could get some re-ratings as time goes on if we do get a November cut, if they only pass on 15, maybe 20 basis points on that. So that does effectively improve their net interest margins longer term in that regard. But I think on a pure valuation, as we're saying at the moment, that I think you buy the dips in the banks at the moment, and I think that's probably the case. I mean, the upside is relatively limited. In terms of rate cuts, I'll be looking elsewhere. I think if you look at the retail space, given my perception that housing could improve if we get down to 2.5% next year, probably Harvey Norman would stand out as a good one. I mean, it's got the kicker of retail action as well, but it's also got a big white goods area which benefits from people buying houses as well. So perhaps that could be a stock that you could look at longer term if you believe that rates are going to go down to 2.5%. Yeah. But in terms of banks right now, I think that they are looking a little bit lofty. I mean, UBS came out yesterday saying that they see they've got all of them as a hold at the moment, and the sector's very much an underweight. I still think my preference right now is to be in the material space. I think that's where the funds are flowing. I think that's where we're seeing the upside at the moment. But a lot of it depends on some of the further macro issues clearing up, a lot of them in Spain and also Greece at the moment, which I think will resolve, but probably take a little bit longer than the market's hoping for right now.
It's funny you mentioned Harvey Norman. That's up another 2% today, so that's sticking with the gains. JB Hi-Fi adds to it as well. Hey, Chris, thank you very much. We appreciate all that.
All right.
Cheers.